I want to bring in Jim Davalos. He's the portfolio manager and research analyst over at Horizon Kinetics. He runs the Horizon Kinetics Inflation Beneficiaries ETF. The symbol is INFL. Jim, you started this fund 13 months ago. We've already got $1 billion in assets in this. This is companies expected to benefit from inflation. You have mining, transportation stocks, real estate companies in here, exchanges. But you've emphasized, whenever I've talked to you about that we don't just buy them willy-nilly. You want asset-light kind of assets. Can you explain what that is and what's the philosophy of INFL?
Sure. So I think that it's pretty easy with kind of first derivative logic to say, hey, who can raise prices with inflation? I'm no expert, but I would say Apple can probably raise the price of their iPhones. But a lot of companies are going to have expenses that are as much or greater than they can grow revenue. So that's why it's really important to have a hard asset, so a physical, tangible asset that can benefit from inflation driving your revenue, but absent that those fixed costs or the high capital intensity that drive a lot of your costs of goods sold and SG&A. So in other words, while your revenue grows with a lot of these companies, your margins are also going to expand. So the companies benefit twofold, whereas a lot of other companies are going to have a lot of trouble with the cost side.
Yeah. Now there's certain companies that make a lot of sense. You own land companies, for example. So owning land would be a logical asset. Texas Pacific, you own a bunch of energy companies that are in this fund. But you also own stock exchanges. You own a significant investment, for example, in Deutsche Börse. Yep. Now, why is that an inflation-linked asset in your mind?
So if you think about it, at the end of the day, inflation is a great uncertainty on the market. And financial exchanges are basically, they are the marketplace for selling and buying risk. And so one of the biggest drivers of volume on exchanges, whether it's equities, fixed income, rates, commodities, is volatility, uncertainty. So right now, all of these exchanges, whether you're talking about the US exchanges, the ICE, the CME, the Deutsche Börse, the ASX, they're all printing record revenues. And what does it really cost for them to have all of that extra revenue? I mean, we're sitting here on the NYSE floor, but for them to do another $1 trillion of derivative volume at the ICE, they plug in another computer mainframe. So it's really a toll booth on financial activity, and we've all kind of been spoiled by 10 years of low volatility that has suppressed volume. So I think that the margins and the revenues are going to really go up across the global exchange complex with inflation.
Yeah, and that makes some sense. So market makers, for example, also would do very well. People who would benefit from volatility, high levels of trading, for example, would make a lot of sense. You know, Ben, this is the ETF theme of the moment. You and I have watched all of this go through for many years. We remember pot ETFs. They had their day. Then we had Bitcoin equity-related ETFs. They had their day. Then we had thematic tech ETFs in 2020 and 2021. Now it's inflation ETFs. And, you know, this is the beauty of ETFs. But it also means investors chase themes that get a rush of money, then, you know, fizzle out, either because people get bored with them or they don't pan out. Is it good to allow investors to chase these kinds of essentially fads, is what they are right now?
Yeah, so Bob, taking stock right now on the ETF menu, we currently have a deflation ETF. We've got a number of inflation ETFs. There's a stagflation ETF that isn't filing. So we've got all our various inflation scenarios covered. And the problem, more often than not, is what you see is that oftentimes the contents of that portfolio don't necessarily align with that objective or that theme. Now, that's not to say that there aren't thoughtful sponsors that get things trued up. And I think we've got a case here where there's a good degree of thought that's been put into it. What's more challenging still is just to get the timing right. So by the time most of these funds come to market, we've long since sort of bought the rumor. Many people have sold the news. And all that's left to do is really short sell the thematic ETF, because many investors for some period of time now have set themselves up to be a victim of their own behaviors. We've seen time and time again, buying exactly at the wrong time when all of this enthusiasm, all of these expectations have already been priced in to the securities that are represented in these portfolios. So investors need to think twice, I think, when they begin to approach these things. To borrow from John F. Kennedy, when it comes to inflation or what have you, the best time to fix your roof is when the sun is shining. And right now, as it pertains to inflation, the sun is certainly not shining. The time to batten down the hatches was a long time ago.
There is a behavioral, what Ben is saying is there's a behavioral economics aspect to this whole thing, that people rush in towards the shiny new object, as we like to call it, and suddenly get interested. With that said, you've done very well. When did this happen? January last year, right? As I recall, I had you on right as that came on last year. And now you've got almost $1 billion in assets
over
under management.
1.1.
1.1 right
Yep.
now. And so it does work.
It does.
Ben and I might sit here like, ETF philosophers. I call Ben the ETF philosopher because he is, and I agree with him that shiny new objects, you should be careful about them, but they do work. They do get assets.
Yeah, and I don't disagree with what Ben said at all. I think that there's a big nuance between beta, where you're making a binary bet on CPI, on a commodity, on interest rates. That is for traders, and that's not something that I do. What I've designed is a full cycle portfolio where these businesses, I think they're going to generate very strong economic returns under the pre-inflation status quo. So our returns on equity, 20, 30, 40, 50 plus %. And so there's not a binary bet on inflation. You'll do just fine if it continues. But to the extent that there is lasting inflation, you're going to do very well in these stocks. And so what I call this is a full cycle or multi-cycle way to play a structural shift in the economy that has to do with a lot of these hard assets versus kind of the service dominance of the past decades.